Good evening, TheoTrade. This is Corey Rosenblum, and you're watching the TheoTrade nightly video for the 17th of September here in 2020. And the markets, if you want to use another phrase, have returned to the scene of the crime, dipped their toe into the rough water, or have peered over the edge of the abyss. All those are applicable. But we'll just keep it in simple terms and price levels. So we're looking at the Nasdaq, and in tonight's video, we'll pick up where Don was talking about and continue that logic about markets hitting the edge of support and possibly continuing the sell-off. We are seeing strong bear volume. So keep that in mind as we're looking into the future for this week and next. The markets did bounce on the Fed, but then pulled back after the announcement. And especially for tech stocks, we are already seeing some of them break key support levels. So please bear with us in this video, and we'll talk about those levels and what to expect. But just as a note, we have seen bull volume, and that's just little green bars on the days that are bullish days, has been declining, and red volume, or volume taking place on sell days, has been expanding or increasing. And that is a sign, for the most part, of a distribution or odds favoring a break of support as opposed to a hold of support. So as we go forward, your Nasdaq levels, we'll start with it, is roughly, just simple terms, about 11,000. If you're looking at the Qs, triple Qs, that same logic, I just took those levels off, and that's roughly 267 and 266. You see similar type of volume, maybe not as pronounced, but strong sell volume on the way down. So that is to be cautious. Other time we saw that, taking us back to here, was not dissimilar to this February period where the market was going up, 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 up. Everything was bullish. Everything was great, except for these three little bars right there and the green bars declining. Eventually the red bars peaked to the upside, and I would suggest we're sort of at a similar logic. I do not think we're going to fall in the cliff and bust all kind of support levels like earlier. And that was the coronavirus, the economy was shutting down, and things were a lot different earlier in the year. But just keep in mind, if these levels start to fall, you'll see the shift in supply-demand change and favor the bears. Mainly, those traders that were buying every pullback, rapidly rushing into the bull side of the market, thinking that everything was okay, just talking about Facebook for one, PayPal, Netflix, and those things worked. Buy every pullback. That might be shifting, and if it starts to shift, you'll see those people bail on their shares, and the market will fall faster. So I'll keep tonight's video just focused on the Nasdaq and the tech stocks, but one little peek at the S&P shows that a similar level is about the 3300 or 3300 level, and in the SPY, just for reference, that is about 330 or 332. So those are levels to watch if you're an S&P trader. We'll focus the video on the Nasdaq. Outside the Nasdaq itself, we have the titans of tech, or the monsters of tech. Now this is where my attention is going to be. Maybe yours should be as well. But it's mainly on the fact that the price has broken and closed under that 50-day moving average for the first time since taking it back in early April into May. And it's similar logic to this right here. This is the titans of tech, monsters of tech. It's our TheoTrade symbol. But the same logic takes place in the Nasdaq. So once you break the 50 and fail to bounce back, the dips are no longer bought, they're sold. And the market can fall very quickly. It already has, but this is the last line of defense for short-term traders. Now, let's take a look at some examples. I teased Facebook, but here's the Facebook stock on the daily chart. We'll actually maximize this, take off the hourly chart. Still an uptrend, but everything that is good, right, every uptrend, eventually gives way to a deeper pullback. That is at threat right now. So for Facebook traders or Facebook share purchasers, please watch this 250 per share level. You can begin to set up trades, set up breakdown trades. If you want to play the bounce, this is the last spot to do that. This is the edge of the cliff. This is the market dipping its toe to the downside. Again, take a look at similar type of logic earlier in the year. February, it did come back a little bit. It dipped its toe into the abyss, into the pond, into the creek, into the water, at the edge of the cliff, whatever term you want to use there, pulled back a little bit, then fell into it. Very similar metric taking place now. And we can look at, well, Goldman Sachs is a financial stock, leading financial name that is forming support. And our key level is the 200 per share. Remember, you can trade spreads or any type of other position within these parameters. So the support level is 200. It as well, not a technology stock, sure, but a leading financial stock is breaking that support level. PayPal is doing the same. We don't have a lot of stock data for PayPal. It's not a multi-year stock like Apple or something, but it is breaking support as well. So pullbacks are good until they're not. Pullbacks are the operant strategy and the low-risk trade until markets start to break. I like to use moving averages. You can use trend lines, and that's just with a hand-drawn level. Similarly to Goldman Sachs, strangely enough, we are watching the 200 per share level for PayPal. It as well had an initial bounce off the 50-day moving average. It is not special. It is not magic. It is just an adaptive trend line or a spot to reference. Nothing magical about moving averages, but when a market busts under them, what it says is the market's trading beneath the average price of the last 50 days, or that's about 2.5 months. That's important to note. And that is a spot where traders can, especially swing traders, put and locate stop losses. So those who are buying the dip, number one, it's a deeper dip, deeper pullback than the 20-day exponential. And that's just the average price of the last 20 days, or roughly one trading month. That's why we use the 20. Once it busts under that, it can fall much further. And there is a pattern play. If the market busts under a rising 50-day moving average, it can trade all the way to the 200-day simple. So we're watching these levels, or preparing for markets and tech stocks to dip off the cliff. That is a real risk that was in play. We got so overextended to the upside. Support, if it does not hold, could lead to a further drop. So that is the, on one side, warning about not buying the dips and hoping everything's okay. But the other side is the opportunity. Right? If you are a bearish trader or do like to trade put spreads or trade reversals, this dip into the abyss, dip beneath support, breaking of support on high red or sell volume, that's what you want to see. And that is similar, again, to February into March. So that's PayPal. Netflix is a little stronger, but it too is dipping under support. For Netflix, that's about the, I keep things simple, at the 470, 72, 73 level. Going to Amazon. It as well has broken support. So this is what we call a failure bounce, failure to hold support. As the other examples, when they held support and traded back to the prior high, you're now seeing the market, there's your moving average, break and fail. And it's doing so on high volume. So I'm treating this from two perspectives. Number one, if you're a new trader thinking that every single dip is bought successfully, now's the time to question that strategy. And if you're the other side, you've been shorting, not having that much success except for fade trades, right? Short the high, come out to the moving average. This might be a different animal. This might be a different situation. You might get paid very well for short sell trades or put trades or bearish type of positions as markets fail support levels and trade down to prior price lows, possibly all the way to the 200-day moving average. And again, draw parallels back to earlier in 2020. So these are levels to watch and be careful with. We'll take a look quickly at Google. It as well is breaking support. And for Google, it's about the 1,500 per share level. And there is Apple. So they're all doing the same thing. They all are trending up. They all had their overextended crazy rally through August. They all snapped back like a rubber band. And now they're at threat of going lower and failing the dip and rinsing out the traders who thought every single pullback is a perfect opportunity. It's not. It's just risk management. That's all it is, probability risk management. So as we go through the rest of this week and into next week and eventually into October, please watch these levels. You can compare them on our Monsters of Tech chart. There's the fangs. You can adjust these, but just draw them all together. Note that they're all doing very similar things. As always, be careful and safe. This is Corey Rosenblum with tonight's Theo video for September 17th, 2020.